What is an ETF? Or it is also known as the exchange traded fund. So how do they work for you? In this video, we'd like to present to you how does an ETF works for you. So for instance, this is how it looks like. If most of the time ETF are made to bundle a basket of stocks or bonds that can be traded like stocks. So imagine, for instance, if you want to get exposure to about 500 companies in the top 500 companies in the US, let's say S&P 500. So you couldn't just buy the index directly. So if there's no ETF, what you would do is that you would buy these companies individually uh, from your brokerage platform, and that would be super exhausting and time consuming. So imagine if you spend like 2 minutes per stock, and then you'll be spending to buy 500 stocks, you could be like spending about even more than half a day to do that, right? So that's really exhausting, and to size all of your positions. So the ETF gives is like a service added value. So it bundles all these stocks together automatically, and it allows you to buy and sell at any point of time in the day. So now how the infrastructure looks like is, now ETF providers like Vanguard or State Street Global. So they are these are the two most well-known ETF providers in the industry. So for example, if an investor wants to get exposure to S&P 500, they can actually source for ticker symbol SPX, SPY, or VOO to invest in. So now, right now, the ETF provider is just like a chef. All right, so they package all the stocks under a roof, ETF, and they actually send it to the market maker, and the market maker acts like a waiter. So they go to the table where exchange is like a restaurant where you have patrons coming in. So the only part here is that you have always buyers and sellers buying through their brokerage platform. So of course, this is the part where we always call them the primary markets. All right, and when you have public coming in and buying at the opening time and the closing time of the markets, that's what we call secondary markets. So now you might have come across mutual funds or even index funds. So what are the key differences between these few different funds? So mutual funds, to be plain and simple, they are actually behaving with active portfolio management. So they have portfolio managers that will buy and sell the stocks as they please. So they will add or they will deduct stocks if they're not performing. So this would actually amount up to some certain, they need to pay the portfolio manager salary. So of course, with those expenses, then they have to charge some fees to their clients. So between 1 and 2%. So it is considered quite high because it will eat into your returns. Now let's say, for instance, if you have a capital of 100,000 USD, and S&P has S&P 500 for the past 10 years, it has done an average return for about 12%, an average returns of 12% per annum. So that means that this 100,000 USD would become 112K. All right. So this is like adding on 12K. So, but the fees, let's say for instance, if it's like 2%, then it would be 2% of the entire capital right here per annum. Then that would be amount up to about USD 2004. So the thing is that it is charging like this is like 2% of 112. But what is the amount of this percentage when we divide it with the returns of 12K, right? So if it's divided by the returns of 12K, this is amounting to around 20%. So it's eating about around 20% of the returns. So right here is considered quite high. Even though if they charge 1% of the fee, it's already 10% of the returns. So what you may get up here, you may not get 12K, you what you may get, if it's deducted from the capital, from your returns, you may get about 9,600, right? Instead of expected real returns. So in the long run, the bigger the capital is, if you reach up to 1 million, you get the idea, right? If you reach up to 1 million, then you would have to pay even more, right? This would bounce up to 96,000 per year. All right, the bigger the capital, the bigger you pay. So, all right, you get the idea. So then, now another fund, it's an index fund, and this is where it gives you an exposure to the S&P 500 automatically. So it mirrors the index performance, and this is passive. There's no active portfolio managers that helps to actually add some stocks or deduct some stocks. So because it has no managers to pay this, to be paid with a salary, so the fee can go as low as 0.4%, and you can only trade once per day. All right, with index fund. And the ETF, exchange traded fund, is also considered passive. There's no active portfolio managers. All right, for most of the ETF that tracks the index. But of course now, in the past few years, we also have some active ETFs coming. We have like ETFs that comes into the picture, that it has managers that are active to bring in the stocks and deduct the stocks from the portfolio. But of course, the fees are not directly charged to the client, because most traders, they buy through their ETFs through the brokerage platforms, and they only pay brokerage commission. And this ETF also, they do actually give you dividends, right, from the stocks they own. So, but the biggest difference is that ETF and index fund versus index fund is that ETF can be traded like stocks multiple times a day. But most of the traders, investors, when they go into ETF, very often they are looking for a long-term investment or exposure in this ETF. So, no point no point trading this multiple times a day, right? So now, of course, when we look at ETFs like a Spider, and this is managed by State Street Global, one of the biggest ETF provider, and they do have instruments like healthcare, right, financials, consumer discretionary, basic materials, energy. So all of this comes with ticker symbol. If it's energy, then you have XLE. Then if it's financials, then you have XLF. So this is in the financial sectors, you have like banks and insurance, everything, mortgage. So all those are actually packaged, and all these industries are under one financial sector, represented by this ETF, XLF. So the list is quite huge here. So we have about 11 plus utilities right here. Right. So of course they are represented by multiple different ETF ticker symbols, right? So now buying an ETF is just like buying a song album instead of buying a hit song. So this is like for instance, for a specific industry that has a lot of future potential. Now let's say electric vehicle, or solar, right, or even AI. So there are no clear winners, in my own opinion. There are no clear winners at this moment, but you know that industry is receiving a lot of investment, and you know that has a lot of future, but you don't know which is the clear winner. Clear winner is like a hit song. So if we do not know which is the clear winner, then we will actually consider in buying into the ETF. Now, like artificial intelligence, you have like two choices. You have bots or robo. Then electric vehicle, you have drive. Right, clean energy. This is solar, and maybe some hydroelectric systems. Right, ICLN. Then genomics technology, you can go for ARC-G or Genome. Right, so that gives you two genetic sequencing technology. The exposure for genetics, genetics sequencing, or you call it genomics technology. Right, so it's a part of biotechnology, and well, I do not want to go deeper than that, but I hope it gives you an idea on how these ETFs will work for you. Thank you.